Financial. We're the show that helps you forge a stronger portfolio and cut through market weakness. I'm your lead analyst.
And I'm the market skeptic.
Today, we're putting Parker Hannifin on the anvil. Now, on the surface, this industrial behemoth looks like it's forged from investment-grade steel. It's an absolute titan in motion and control technologies.
But you know, our job here isn't to just admire the shiny surface. Our job is to stress test the metal. Is this company really as solid as it appears? Or are we about to find some hidden cracks in the armor that could shatter when the pressure's really on?
That is the multi-billion-dollar question, isn't it? All right, let's fire up the forge and find out.
Okay, let's just cut right to it. Look at this number on your screen. $11.7 billion.
And let's be crystal clear for everyone listening in. That isn't their quarterly revenue, it's not their total market cap. No, that is Parker's record-breaking backlog of orders as of the second quarter of fiscal year 26.
That's exactly right. This is future revenue that's already been sold. It is locked in. In a world that is just full of economic uncertainty, where markets are swinging wildly on every single headline, a number like this, well, it's a financial fortress. It is a mountain of guaranteed work that is going to keep their factories humming for years. This right here, this is the absolute foundation of our bull case for Parker Hannifin today.
Okay, I hear you. But a huge backlog coming from one really good quarter could just be a fluke, right? A one-time surge that isn't repeatable.
Not a chance. This backlog is no accident. It is the direct result of a truly massive, record-shattering quarter. So before we even start looking for weaknesses, you have to respect the raw power that we're seeing here. We are talking about record sales, record earnings, and record cash flow, all at the same time.
So these are the pillars supporting this financial fortress you're talking about. And right now, from the outside, they look like they're made of solid steel. Let's see the proof in the numbers. Here it is, plain and simple. Record sales clocking in at $5.1 billion.
That's a huge number, but what's more important to me is that 5% organic growth. That tells me they aren't just buying other companies to grow. The core business itself is expanding. It's healthy.
Precisely. Now look at the engine underneath it all. Record adjusted earnings per share of $7.22. That's a 16% jump.
Now that's leverage. They are squeezing more profit out of every single dollar of sales. That's what you want to see.
Which brings me to the margins. A record adjusted segment operating margin of 27.4%. I mean, for an industrial company, that is absolutely elite territory. And finally, the lifeblood of any company, record cash from operations, $782 million.
That is a mountain of cash. So these aren't just abstract figures on a spreadsheet. You're right. These are the foundational pillars of the bull case, and I have to admit, they look rock solid.
And hey, you don't just have to take our word for it. Parker's own quarterly report calls it a great start to the fiscal year.
Market skeptic. Yeah, that might be the understatement of the year. But as we both know, management is paid to be optimistic. The real story, the devil, is always lurking in the details. So the real question for me is this incredible strength sprayed evenly across the entire company, or is one division doing all the heavy lifting for everyone else?
That is an excellent question. So let's do just that. Let's peel back the layers of this onion and see where all this strength is really coming from.
When you really dig into the numbers, one segment just immediately explodes off the page. It's not just another pillar holding up the fortress. This thing is the main engine. It's the massive jet turbine that is driving the entire structure forward and lifting everything else up with it.
And we're talking about their aerospace systems segment. And looking at this data, its performance isn't just good, it's on another level entirely. It's flying in a totally different stratosphere than the rest of the company.
So take a look at the full year numbers from fiscal 2025. This really helps to grasp the sheer scale of what's happening here. The aerospace systems segment grew organically by nearly 10%. For a business of this size, that is absolutely phenomenal.
But now look at the rest of the business. The massive diversified industrial segment, which, by the way, is the bulk of their company, it actually shrank by 2.5%. So the only reason the entire company posted any positive growth at all is because the aerospace division strapped the whole organization to its back and did all of the heavy lifting.
It single-handedly dragged the entire corporation into positive territory. From an operational standpoint, that's incredibly impressive execution.
I agree. But from a risk management standpoint, well, that's not just impressive, it's also a little bit scary.
You know, I'm the market skeptic for a reason, and when I see a chart that looks like this, alarm bells start to go off in my head. Yes, that aerospace bar, the blue one, it's a thing of beauty. A nearly 10% growth rate is something any CEO would kill for. But look at the sheer disparity here.
You have one segment flying into the stratosphere, while the other, much larger segment, is actually losing altitude. That huge gap between the blue bar and the red bar, that's what we call a dependency. It's a structural imbalance.
So the critical question you're asking is this: is this a story of diversified, widespread strength, or is it really a story of one spectacular overachiever that's masking some pretty serious problems everywhere else?
Which brings us right back to our core metaphor. We started this whole conversation with the idea of a fortress. But look, any engineer will tell you a fortress is only as strong as its foundations. And right now, it's starting to look like one massive steel-reinforced pillar, the aerospace division, is supporting a disproportionate amount of the total weight.
So, is this just hype, or is it durable? We have to know. Is that one pillar truly strong enough to support the entire structure? Especially if the ground underneath the other parts of that foundation starts to get soft and crumble. That's the kind of question that keeps a smart investor up at night.
So that is exactly what we're going to do now. It's time to put on the hard hat, grab a flashlight, and get a little dirty. We are going down into the foundation to inspect the rest of this structure, specifically the diversified industrial segment.
And this is the bulk of Parker's business. It's where they make basically everything else, from hydraulic pumps to filtration systems. If there were any cracks in the armor, any hidden stress fractures in the steel, this is where we're going to find them. Let's drill down.
Okay, look, to be fair, and we always try to be, things are looking better in the most recent quarter. The bleeding seems to have stopped. The industrial segment is actually back to positive growth. You can see orders in North America are up 7% and international is up 6%. That's a solid turnaround. You can't deny it.
But context is everything. Look at what Aerospace did in that same period. Orders are up a staggering 14%. That's still double the growth rate of the industrial business. So the performance gap, while it's narrowed from the disaster of last year, is still very much there. The imbalance persists. Aerospace is still the star quarterback throwing touchdowns, and the industrial segment is just grinding out a few yards at a time.
And let's get even more granular here. Let's look inside that big industrial segment at one of its key end markets, the off-highway vertical. So think construction machinery, big agricultural tractors, mining equipment. This is a huge chunk of their business, about 13% of their total sales.
And it's a deeply, notoriously cyclical market. When the economy is booming and construction is hot, they can't make these parts fast enough. But when interest rates go up and construction projects get put on hold, this market can fall off a cliff.
Exactly. So the question that I have is, how durable is this recent recovery in the industrial segment? Is it built on solid ground? Or are key markets like this one, which are highly sensitive to economic headwinds, really vulnerable to a sudden slowdown? The health of this specific market is absolutely critical to the whole story.
That is a fair challenge, skeptic. You've correctly identified a potential vulnerability, the heavy dependency on aerospace, and the built-in cyclicality of their industrial segment. And look, if this were just some company drifting along on the economic tides, I'd be worried too. But this is where we have to look beyond just the quarterly numbers and examine the company's strategic blueprint.
You're telling me they have a plan for this specific problem?
They have a doctrine. It's called the Win Strategy, and it is the company's direct, explicit answer to the very concerns you've just raised. It's their playbook for reinforcing the entire fortress, brick by brick.
The Win Strategy is basically Parker's operating system. It's in their DNA, and it's broken down into 4 core pillars: engaged people, customer experience, profitable growth, and financial performance. Okay, that sounds like a lot of corporate buzzwords you'd see on a motivational poster. What does it actually mean for investors? Think of it like a simple PECF playbook for success. P for people, E for experience, C for profitable growth, and F for financial performance. It's a disciplined framework that guides every single decision they make, from the factory floor all the way up to the boardroom. For our analysis today, that profitable growth pillar is the key. That's how they plan to fix the imbalance we've been talking about. And within that profitable growth pillar, there is a clear 3-step playbook. First, they focus on strategic positioning and innovation, always trying to stay ahead of technology trends. Second, they leverage their absolutely massive distribution network to grow market share organically. Market skeptic.
But the real weapon in their arsenal here is step 3, isn't it? Strategic acquisitions.
Exactly. This is the key tool they use to actively rebalance and reinforce their corporate structure. They don't just sit around and hope for a segment to improve on its own. They go out into the market and they buy the strength they need, exactly where they need it most. Here is Exhibit A of that strategy in action. The acquisition of Meggitt was a massive, game-changing move. It was a conscious decision to double down on their strongest segment. They took the primary engine of their growth, Aerospace, and they bolted on even more capability, more technology, and more market access, especially in that high-margin defense sector.
So this wasn't just a random purchase. It was a very calculated move to make their strongest pillar even stronger, giving it more power to carry the entire company forward.
Okay, analysts, but that just reinforces my point about dependency. They made their strong arm even stronger, while the other arm is still lagging behind.
But here's where you're missing the other side of the coin. Look at this. The more recent acquisition of the Filtration Group is a direct counter-argument to your point. This move is all about reinforcing the industrial foundation. They identified filtration as a key, high-margin, and less cyclical part of the industrial world and made a major strategic addition. They are actively using their capital to shore up the very segment you were so concerned about. They're patching potential cracks before they can even form.
And for anyone out there who thinks this is all just a theory on some corporate PowerPoint slide, here is the definitive, undeniable proof. Just look at the compounding growth in their adjusted earnings per share over the last decade. It's gone from under $7 back in fiscal 16 to a guided $30.70 for fiscal 26.
Market skeptic, that chart, that is a machine.
It's more than a machine. That line goes up and to the right through different economic cycles, through trade wars, through a global pandemic, through all kinds of different market conditions. The win strategy isn't just a plan. It is a proven engine for creating shareholder value year after year after year. The results just speak for themselves. This is what disciplined execution looks like in the real world.
All right, so we've seen the bull case, which is built on a fortress of record-breaking numbers. And we've heard my case, where I've pointed out the potential cracks of dependency and cyclicality.
And I've countered that with the strategic blueprint of the win strategy. So now it's time to bring it all together for the final verdict. And to do that, we need to stop looking at their past track record and start looking at what management is promising for the future.
And their guidance for the full fiscal year 2026 is strong. I mean, really strong. They're forecasting organic sales growth of 4 to 6%. That is a significant acceleration from the 1.1% we saw back in fiscal 25. Critically, that guidance implies that a strong, sustained recovery in the industrial segment isn't just a hope, it's management's base case expectation.
And they're also guiding to maintain those elite-level adjusted segment operating margins we talked about. And look at the cash flow, a massive $3.2 to $3.6 billion. This guidance really shows management's confidence that both of their major segments will be performing strongly moving forward, not just Aerospace.
And they're not stopping there. These are the company's long-term targets, all the way out to fiscal year 2029. And I have to admit, as the skeptic, these numbers are incredibly ambitious. They are explicitly stating their goal to become a top quartile performer among all of their industrial peers. Just maintaining 4 to 6% organic growth for 5 straight years is an incredibly tough thing to do.
Hitting a 27% operating margin and a 17% free cash flow margin consistently would put them in truly elite company. And targeting double-digit EPS growth every single year, that is the blueprint for significant long-term shareholder returns. They aren't just aiming to be good, they're aiming to be one of the best industrial companies in the world.
So what is our final verdict here at Iron Financial? After running the numbers and stress testing the model, Parker Hannifin's structure shows immense tensile strength.
Market skeptic, the initial concerns I had about the dependency on Aerospace, while they were valid, are being actively and effectively addressed by a disciplined and, more importantly, a proven strategic blueprint.
The win strategy, especially through their use of smart acquisitions, is designed to systematically reinforce any potential weaknesses before they become major problems. We've tested the metal, we've hit it with a hammer, and it is holding up. But we are going to leave you with this final thought. The blueprint for this company is solid. The materials they're using are clearly high grade. The construction is well underway. But even the best laid plans can face a hurricane.
The biggest question mark here isn't internal, it's external. The strategy is sound, but can management continue to execute this plan flawlessly in the face of uncertain macroeconomic headwinds? Things like rising interest rates, a slowing global economy. Those are powerful forces that are completely beyond their control.
And that is the final variable. It's the one question you need to answer for your own portfolio. Thanks for joining us on the Iron Financial.